Have you ever stopped to think about what really happens after you click buy on a stock? I mean, it feels totally instant, right? But behind that single click, your order goes on this incredible hidden journey through a world of high-speed trading and some seriously complex financial plumbing. So let's pull back the curtain and really follow the money to uncover the secret life of your stock trade. Right, so you've done your research, you found the stock you want, you hit that button, and bam, the trade is done. Simple. Or is it? Where did your order actually go? And who or what decided the exact price you paid? Well, the answer is way more complicated and honestly a lot more interesting than you probably think. So the first step on this hidden journey isn't a straight shot to the New York Stock Exchange. Nope. Your order's first stop is your broker. And what they do next, well, that's where our story really kicks off. And it involves a pretty controversial practice that's right at the heart of how modern markets work. It's a mouthful, but it's called Payment for Order Flow, or PFOF for short. You know all those commission-free trading apps? This is a huge part of how they make their money. Instead of charging you a fee for each trade, they get paid by huge wholesale firms just for the right to handle your trade. Let's trace the path step by step. First, you place your order. But instead of your broker sending it to an open exchange, they often sell your order to a massive wholesale firm, what we call a market maker. Then, that firm is the one that actually completes your trade, a lot of times by selling you shares they already own or buying the ones you're getting rid of. And this is where it gets a little sticky. See, your broker has a legal duty to get you something called best execution, basically the best possible price at that moment. But with PFOF, they're also getting paid by these market makers. So the big question is, are they sending your trade to the place that gives you the best price or to the one that pays them the most? That's the conflict of interest right there. Okay, so once your order is in the hands of that market maker, it enters a completely different universe, a world where time isn't measured in seconds or even milliseconds, but in microseconds. Welcome to the wild world of high-frequency trading. High-frequency trading, or HFT, is all about speed. It uses these unbelievably powerful computers and complex algorithms to buy and sell stocks and other assets at speeds that are just impossible for a human to even comprehend. We're talking millions of orders in the literal blink of an eye. It's wild. Now, HFT is a classic double-edged sword. On one side, proponents will tell you it adds a ton of liquidity to the market, making it easier for everyone to buy and sell, and that it helps narrow the bid-ask spreads. That's the tiny price gap between what buyers will pay and sellers will accept. And smaller spreads can save us all money. But on the other side, critics are worried that a system built on pure speed, with humans taken out of the loop, is incredibly fragile and can lead to these sudden, massive market swings. And that risk? It's not just a theory. Back in 2010, we saw it happen during the flash crash. The Dow Jones suddenly plummeted nearly 1,000 points in just a few minutes, and then, just as mysteriously, it bounced right back. A lot of people pointed the finger at high-frequency trading algorithms that seemed to just spiral out of control, showing everyone just how fragile these high-speed markets can be. Events like the flash crash are a perfect example of how quickly problems in one corner of the market can spread everywhere. And that's exactly why we need a referee. In the US, one of the key players watching over all of this is the Federal Reserve. Their job is to zoom out from our single little trades and monitor the health of the entire financial system, looking for any cracks that could lead to a meltdown. A huge part of the Fed's job is to keep the whole financial system stable. You can almost think of them like financial meteorologists. They are constantly scanning the horizon for storms, looking for vulnerabilities, those weak spots that could turn a small problem into a full-blown crisis. It's a constant, high-stakes watch. The Fed basically has this 4-point checklist for spotting trouble. First, asset valuation pressures. Our stocks or real estate in a dangerous bubble. Second, excessive borrowing. Are regular people and businesses taking on way too much debt? Third, leverage in the financial sector. Are banks and hedge funds making huge bets with borrowed money? And finally, funding risks. The danger that the short-term lending that keeps the whole system running could suddenly just dry up. And here's where it all connects back to our trade. That third vulnerability, excessive leverage, is a big concern right now. The Fed has specifically flagged that some hedge funds are using a ton of leverage, borrowed cash, to juice their trading strategies. And guess what? Many of these are the same firms that dominate high-frequency trading. It creates a system where just a few highly leveraged players can have a massive impact on the entire market. So we have this really complex system in the US with PFOF and HFT all tangled together. But is it the only way to do things? Let's take a look at a real-world experiment that shows us what might happen if you take one of these key pieces out of the puzzle. To see how this can play out differently, let's just hop across the Atlantic. Here in the US, payment for order flow is a central part of the whole retail trading game. But over in the United Kingdom, regulators took a totally different path. They effectively banned the practice back in 2012 because they were worried about that exact same conflict of interest we talked about. So what happened? Did the market fall apart? Let's just look at the data. Before the ban, back in 2010, only about 65% of regular retail-sized trades in the UK were actually getting the best available price on the market. That means a full 35% were not. Okay, now check this out. This is the market just 2 years after they banned PFOF. The percentage of trades getting the best price jumped to over 90%. That is a massive, massive improvement in the quality of trades for everyday investors. And it didn't even stop there. The best price itself actually got better. Those spreads, that tiny gap between the buy and sell price, they got smaller. And what that really means is less money for the middlemen and more money in the pockets of investors. The ban seems to have created a more competitive and efficient market for everyone. So this really brings us to the core dilemma, doesn't it? On the one hand, practices like payment for order flow have made commission-free trading possible, and that's opened up the markets to millions of new people. But on the other hand, as that UK example shows, it might come at a hidden cost to the overall quality and fairness of the market. So, the ultimate question we're left with is this. What do we really want from our markets? Do we want the unbelievable speed of HFT, the easy access of commission-free trading, or the fairness and stability that might come from a more transparent system? Figuring out how to get the right balance between all three, well, that's pretty much the defining challenge for modern finance.